Steve McBoyle, one stock you like over at the Royce Heritage Fund is Standard Motors. They make auto replacement parts, electrical systems for cars. So with the rise in new car sales because of the improving economy, why do I want to own Standard Motors?
Sure. Well, first of all, to begin with, in the Royce Heritage Fund, we invest in unique business models that generate strong free cash flow that reinvest it back into high rates of return. Standard Motors is a classic example of that. Standard Motors is obviously the large supplier to the automotive aftermarket parts business. This is a growing business. If you think about the number of cars on the road today, that it continues to increase. Cars are becoming more older, and again, they're becoming increasingly more complex. If you think of a car today, there's more cable in a car today than there was in the first space shuttle sent to the moon. So the electrification of a car is obviously a very favorable trend for Standard Motors to the extent that they provide sensors, cables, and wires. So Standard Motors, you have the ability to partner with a family-run business, growing share, obviously addressing a market that continues to grow, and it's an uncommanding valuation, 13 times earnings, yielding 1.5%, and has 20% return on invested capital over the last 5 years.
And you're also bullish on Reliance Steel. This stock's down around 20% in the past year. A lot of worries about cheap metal imports, big glut out there. How is this going to turn around and recover?
Sure. So Reliance Steel is the largest metal service center company in the United States. Since going public, they've effectively acquired 60 businesses and have now created the largest network of service centers in North America. And yet the industry continues to be highly fragmented, so they'll continue to gain share over time. Your point is a good one. Obviously, there's current concern on Wall Street with respect to the increased imports that we're seeing. It is inflicting some pricing pressure, but we actually think imports have peaked. We actually think in the back half of the year, prices will stabilize, if not improve. And if you think of Reliance, with over $10 billion in sales, they obviously are very tied or have high levels of leverage to increase pricing and volume. They do also serve the energy patch, 10% of sales, but they're a direct beneficiary of non-residential growth that we're seeing here in the US, which is very favorable. So Reliance, 55 years of consecutive dividends, currently yielding 2.7%, all trading for 1.1 times book value. Very cheap.
And then finally, you're positive on Valmont. They make metal for the irrigation business. They supply a lot of farmers out there. Crop prices have come down. Farmers don't have as much money. So why do I want to own Valmont?
So Valmont, as you say, leading center irrigation business in the US. Obviously, 2015 is going to be a tough year for Valmont. We've obviously had farm incomes take a big hit. Corn prices are down. But if you actually step back, Valmont is serving some very favorable long-term trends. We know that irrigation provides 30% increase in yield for farmers. We know that demand for food only continues to rise. Water continues to be scarce. We're long-term investors, and so we think we're serving favorable long-term trends. Valmont is a duopoly. We like the fact that management has been able to manage through past cycles before and have done well by holding prices. Valmont's a market leader. It's trading close to the bottom of the cycle. We think trough earnings are $7 per share, normalized earnings closer to 12, so it's effectively trading at 10 times normalized earnings. They've had high returns on capital for a sustainable period of time, and management agrees. They bought back 10% of the company last year and have another 10% authorized for this year.
All right. Thanks a lot, Stephen.
Thank you very much.
Thank you for watching The Street.